Okay. All right. Thank y'all so much for joining us today. This is going to be the second in a three-part series for sponsored by Hancock Whitney Housing and Financial Empowerment Series. This particular session is on credit management, budgeting, and financial health. We have some other sessions coming up at the end of this month that I'm very excited about. And when you're ready, go to imlegacy.org and register on those. That link will be available a day or so after this last session for part two. And so if you did not join us for part one, you're going to be so excited to hear from this community partner, Ms. Raina Winfield, and some of the support services and resources from Hancock Whitney. I'm with Legacy Business League, Angie Juzang. I'm a co-founder, and I've had the pleasure of working with these individuals over the last couple of months on this particular series, and then prior to on some other projects, and just seeing the dedication and commitment and passion and the knowledge that is coming out of these sessions is just, heartwarming and very beneficial. If you've never been through the home buying process, this is home buying 101. I wish that I had gone through it myself, and it's really given us the ins and outs. I hope that we can take these videos and get it out to a broader audience and use this as really a toolkit. We're developing toolkits here. So I'm going to turn it over to LaCarsha, and she is going to tell us what to expect today.
Absolutely. Thank you so much, Angie. As she mentioned, I am LaCarsha Babers, and I'm the Community Outreach Officer here at Hancock Whitney Bank. We welcome each and every one of you to session 2 of the Housing and Financial Empowerment three-part series. Today, we're going to talk to you, as Angie mentioned, about credit management and budgeting. Just to give you a little bit of information about Hancock Whitney Bank, we have over 200 financial centers that are conveniently located across 5 states to help meet the credit needs of the communities we serve. We're in Alabama, Florida, Mississippi, Texas, and of course, Louisiana. Our mission here at Hancock Whitney Bank is to help people achieve their financial goals and dreams. One of the ways in which we do that is through home ownership, and that's why we've invited each of you here today. At Hancock Whitney, we understand that home ownership is the American dream for so many people. Owning a home is a key component of creating generational wealth for families as well as their communities. We also know that being a first-time home buyer, and even if you are an experienced home buyer, you can sometimes feel a little bit overwhelmed by the entire home buying process. Well, our goal for this entire series is to provide you with the education, the guidance, the resources that you need to become better prepared and more confident as you navigate your way through the home buying process. We want to help you turn those dreams into reality. We have, as Angie mentioned, for session 2, credit management, budgeting, as well as financial health. But after this series, we have one more series coming up. Again, it's a 3-part series. We have another session coming up to celebrate the month of June. As she mentioned, we'll have those links up so you can register, and we'll be in a couple of weeks, you'll be able to join us again. So we have here today a HUD certified counselor, Raina Winfield. She's going to talk about money and credit management. We have our mortgage loan originator, Brian Hassenkemp. He's going to talk about capital, your assets. And then we have our mortgage loan originator, Mindy Dinacola. She's going to talk about what to expect. So we ask that you get your notebooks and your pens out and be prepared to take some notes, because these qualified, educated experts will have a lot of detail to share with you, and you don't want to miss it. So we'll go back to you, Angie, and you'll give us directions on what you'd like for us to do.
Sure, fantastic. So we're going to transition and allow Raina Winfield to tell us a little bit about Mid-City Redevelopment Alliance. So you all can hop off camera for now, and I'm going to, and while she's introducing herself, I'm going to pull up the PowerPoint that she is going to share. So tell us a little bit about the organization and what you all do.
Okay, again, my name is Raina Winfield, and excuse me if I sound a little stuffy, but again, my name is Raina Winfield, and I am the program manager of the Homeownership Center here at Mid-City Baton Rouge, Mid-City Alliance, I'm sorry. Also, I'm a HUD approved housing counselor here. I've been here since 2011. So I've been here quite a while doing housing counseling, credit counseling, and also financial education. So we do those things. We do first-time home buyer education, as well as we do development, also community building and engagement. So we also do things in the community. We have different aspects of the homeownership center. It's like a all one-stop shop. What you do is you come in, you get acclimated with the program, you start the process, and then what we do is we go with you from the beginning all the way to the closing table. So today what we're going to do is we're going to be talking about budgeting with a spending plan.
Now, Raina, can you see just the full screen, or can you see the preview? Can you see the presentation?
Yes, ma'am.
Okay, and the full screen, just a full screen and not just the preview, right? I just want to make sure it's okay. Perfect.
Yeah.
All right, please proceed.
Yeah.
Thank you.
Okay. So again, I'm going to tell you today, we're going to get started talking about budgeting with a spending plan. Everyone knows the first thing before trying to purchase a home is knowing your finances, knowing your expenses, and knowing your income. So we're going to discuss those things today as we get started. You can move to the next slide. Can you go to the next slide for me? Okay, thank you. All right, so getting started with the spending plan. First of all, the importance of getting started with the spending plan, it helps you get, set spending and saving your priorities, directs you where your money needs to go, and helps you manage your cash flow. So everyone should have a spending plan in place, and everyone should be able to have it and engage their family members and make sure everyone is on the same page. So we're going to discuss those things today moving forward. Next page. All right, and so these are some of the steps that writing a spending plan, getting started with the spending plan and knowing those steps and moving forward with one. The first thing you need to do is identify your goals and your values. So what you want to do is identify the things that you're trying to accomplish. Number one, it may be purchasing a home. Number two, it may be just building up your savings to put a down payment down. Or number three, just having assets just to, start that behavior of savings in the household. Number two, you're going to track your income and your expenses. So knowing what your income is, your total income in the household, and your expenses as they may change every month, but you need to know what your expenses is and what you pay on a monthly basis. Number three, your assets, your current situation, meaning that you're going to go by what you're making right now, not what you made a year ago or what you plan to make in the future, but what you're making right now is to have a true budget. You need to know what you're making and what's your monthly income. Number four is making adjustments. So know that your budget can change at any time. It doesn't have to stay the same. It's not going to stay the same because you're going to have different expenses that change. You're going to have irregular expenses, and we're going to talk about that a little later. So they will change on a monthly basis, and it's okay to change those expenses. And then also creating that spending plan, and you're going to follow, track, and adjust. Next slide. So understanding what is important about a spending plan. Number one, it helps you to prepare for larger expenses. You may have some emergencies that come up. You may have some things that you have to take care in your home. You may have some medical emergencies, and a spending plan will help you be able to, foresee and help you with, making those payments on things that you come across, or if you have, like I said, any expenses that's not planned, you'll have that emergency fund set aside for those things. To encourage savings. So everyone has some kind of rule about savings. Most times people say, okay, so let's save 10%, let's save 6 months worth of income. And it's hard to save that. So I don't really have a set goal. I say what's comfortable for you and your family. It could be either $5 to $10. It can go all the way up to $500. It just depends on your income and what's comfortable for your household. Also, to prepare for surprise expenses. So those things like if your car breaks, your air breaks, you have that emergency fund set aside for those things, and it won't be just so overwhelming for you and your family. To accomplish goals will be discussed: home buying, just saving, and also any other big plans, vacations, anything that you have planned for your family. And to identify wasteful spending. So basically, when you start your monthly spending plan, you are start to identify things that, oh, I didn't really realize that I was spending this much on that line item. Meaning you may purchase lottery tickets or any other, kind of behaviors that you may have on a monthly basis, and you don't realize how much money you're spending on those things. And what I tell individuals, do that times 12, and you'll see really how much money you're spending on that. Is it something that you need, or is it something that you want? You just want to make sure that your spending plan is always positive. You're not in the red every month. Next slide. So another thing, so assets and expenses. So assessing your cash flow, you're going to understand what's important about that. So you're going to determine your monthly income, you're going to calculate your monthly debts, and you're going to calculate your bottom line. So once you start subtracting those expenses from your income, you'll see your bottom line. Is it really what's your bottom line? Or is it something that we can, kind of fix, and we can make it positive, or try to, cut some things back? So your spending plan is going to show you your spending habits and how you can either encourage better spending habits, or you can, just help your family out with theirs as well. So the different types of expenses that we discussed that you're going to have those different expenses that I say that change. You're going to have some that's going to be regular and they're going to be fixed. You're going to have some that's going to be regular and then they change, meaning like a water bill, light bill. They're going to be, every month, but they're going to change. And then you're going to have your irregular expected expenses, meaning that they may not be so often, but you may have to pay those things like every other month or every 3 months. Irregular unexpected expenses, like if something breaks or something like that, that all should be a part of your spending plan. And how you can do that is put aside for your emergency funds or your savings fund. And your emergency fund is going to be different from your savings. Your emergency is for emergencies. If you need to use that set of money, you want to make sure that you pull from your emergency funds and not your savings. So I try to encourage families, if you're going to save, make sure it's something that you don't find yourself going in on a monthly basis. And you also can make sure that when you save on a monthly basis, have it come direct to your savings account straight from your check every month. That way you don't really see it. And if you start off with a low amount, it won't really, impact you as much. You'll know it's going there, but it's not something that you have to pull from on a monthly basis. Next plan. All right, and income is money that comes from wages, child support or alimony, self-employment, public assistance, interest and dividends, Social Security, and other services. I get this question, not information, but I get this question a lot. What is considered income? So these are the things that you can consider as income when you're doing your monthly budget, and also when you're trying to purchase a home. Just knowing your income is going to be key when you're trying to get to that goal that you're trying to reach. So make sure that you understand that these are the things that is considered income. Next slide. Gross income versus net income. This is very important when you're trying to do a budget. Gross income is basically what you receive before taxes. So we don't live off gross income, we live off net income. When you're trying to purchase a home, they go by your gross income. Your net income, like I said, is going to be after taxes. So that's what your family really lives off of. So when you go to try to purchase a home, you want to make sure that you understand your budget before you even get to that point. You want to make sure, look, I understand that you may be going by my gross income, but this is my net income. I have these expenses that's not showing on my credit report, but these are the expenses that I pay on a monthly basis. It has to be in your budget, so you need to know what's your bottom line and what you can afford as far as a house note. Also, Social Security income could be your retirement benefits, your disability benefits, survivor benefits, or Medicare benefits. So your net income, like I said, is going to be your total income minus your deductions. Next slide. All right, and so what we said, make adjustments. So on your budget, you can make adjustments to allow you to have that positive income at the end of the month. You can increase your income. Either you can you spend less, or you can do both. You can increase your income. We're going to talk about certain things you can do to increase your income, how to spend less, or do both. Next slide. All right, so maximizing your income. You can sell things. They have a lot of websites and sites online, apps that you can sell things and make extra money, handbags, your used items, gently used items, and you can receive money from it. You can receive income, and you do that on a monthly basis. That could become like your second source of income. Rent out a room, your car, other stuff. I know that this is just some some examples. I'm not saying that, you know, you should rent out your room, but if you feel comfortable doing these things, then this is something that you can do to maximize your income. Freelance or start a small businesses. During COVID, we had a lot of individuals that started their own business. They were laid off, the hours were cut, so they started doing small businesses on the side. This could also maximize your income and also let you do what you enjoy doing as well. Take a part-time or full-time job. I don't really advocate for it, but if it's something that you would like to do and you feel like it won't take time away from your family, then, you know, if that's something you don't really have a spouse or kids or anything, that'll be something that's beneficial to maximize your income as well, or apply for benefits. Next slide. All right, so reducing your spending. Some of the things, these are, like I said, some examples that you can start changing those behaviors to reduce your spending, making many cuts. Look at your budget every month, try to see where you can cut back. And you can see, like I said, that positive income at the end of the month. Comparison shop. Instead of just purchasing the first thing that you see, you may comparison, go online, Google, and see where you can find it, you know, at a lower price and purchase it on that website. Use coupons and sales. I always shop a good sale. Shoe sale, bag sale. So you don't just jump and buy things. You could wait till it goes on sale, because 9 times out of 10, it's going to go on sale eventually within the next couple of months. Eat in as much as possible instead of, you know, eating for lunch every day. Start trying to bring your lunch to work. If it's just, you know, maybe you don't have to do it every day, but you can do it, maybe start off with 2 times a week, three times a week, just to cut back on the expenses of going out to eat on lunch every day. Buy used clothes. Now, I like vintage clothes. That's up to you. If you know, if you're into that, buying used clothes, you know, it's much cheaper than buying, you know, new clothes. Trade services, like I said, you can go online, buy, sell, and trade. You may have something that's, you know, gently used, and you trade it for something that you need right then and there. Attend free events instead of paying for, you know, what I want to say, concerts and things like that. Try to find events that's outside, that's free, like this workshop. It's a financial workshop, and it's free, but the information is very beneficial. Just because it's free don't mean that it's not valuable. So, you know, try to find those things, go on Eventbrite and find those things that you're interested in, and make sure that, you know, it's free. Plan meals and shop with the list. Always go to the store with, this is what I do, I always go with cash. I may go, if I'm going to grocery shop, going with $100, no credit cards, nothing like that. That way, if my $100 gone, it's gone. I'm not going into my purse. Okay, well, let me put this extra 20 on my credit card. So when you go in with the list and go in with cash. Refinance vehicles, you know, homes, anything like that to lower your note if it's beneficial. Carpool, save energy. So they have a lot of energy efficient things that can go into your home now that will allow you to save on water bills, electricity bills, and things of that nature. Bundling items. Increase spending money for, include spending money for all. So on your budget, you want to make sure you have spending money for each person in your household. So once that spending money is gone for the month, then it's gone. But if you budget for it, then you should be okay. And as long as you're positive. Choose appropriate financial products and services. Next slide. All right, so writing your spending plan. What you want to do, I can't really see that because it's dark, but I do have it. So writing your spending plans, you want to plan according to your current income. Like I said, your current income, what you're making today. Plan ahead for 6 months. So you want to make sure the budget is kind of mirroring how you picture every, moving forward for at least 6 months. Include spending money for all, set aside money for emergencies, and make sure everyone agrees. So make sure your household is definitely on the same page as you. Because if everyone's on the same household, everyone has the common goal, then you're going to see everybody, pitching in and trying to, save here and there and be on the same page as you. Next slide. All right, so that concludes my part of the presentation. This is my contact information if you wanted to, have some other, further interaction with me, and that is it.
The question, thank you so much, Raina, for putting that together and for reviewing that. We did have a question that says, is the PowerPoint going to be available? The video will be available and the PowerPoint is part of that. So is there anything else that you want to tell us about your organization in terms of how you can help in the home buying process? Do you help with the budgeting? Do you help with the budgeting?
Right. So when you come in and you schedule an appointment, so when you complete any application you complete with me, we do a budget. So if it's, foreclosure prevention, if it's pre-purchase education, if it's just for financial literacy, any application that you complete, we have a one-on-one interaction, meaning that we're going to complete a budget. We're going to go over your finances, go over your credit. So when we sit down and we do a budget, I'll give you a budget. We do it together, but I'll give you a budget to take home so you can see within, 4 weeks what you're truly spending and what you sat down and you told me. So when people see it in black and white, they start to see, oh, okay, I told her that I spend this on food, but I actually spend 3 times this on food. So you're actually writing down everything, and you do it for 4 weeks to make sure you get your true budget in. So what's comfortable for you? So we do that in our intake sessions.
And why is this important part of the home buying process?
Because like I stated before, it's important because you have to know your income and your expenses before you try to purchase a home. Are you ready to purchase a home? Like, can you afford to purchase a home? So when we sit down and do your debt to income ratio, and debt to income ratio is basically what it is, your debt versus your income. If it's out of whack, if your debt to income ratio is too high, can you, pay down some things? All of that is dealing with your budget.
Okay.
When you go to get a mortgage, they're not going to say, oh, we're going to add in your light bill, we're going to add in your water bill. they're looking at what's on your credit. Okay. So if all of that is not on your credit. So you want to make sure before you get to that point, you know what those things are.
Okay. If you have any questions or even comments, like if the information that she has presented is good and you want to highlight something that you learned, please feel free to put that in the chat. We'd love to hear from you, or in the question and answer section. So thank you again, Raina. And I know that you'll be just off camera kind of available in the event we have any additional questions. We're going to move on to Brian and continue on with the PowerPoint.
Well, good morning, everybody. Hope everybody's doing well. Raina, those ideas were really excellent. And, the biggest thing I see before I get started is having the right team of people around you to assist you in getting what can, sometimes seem like a pretty scary process. But getting those people around you and helping you every step of the way, like Raina, that really makes a huge difference. And I'm going to be talking about a lot of things here and kind of going over a general definition for you, but I'm always available and you'll have my contact information. If you'd like to talk with me individually, I can clarify anything that you might need clarifying on. But we're going to kind of start out and just talk a little bit about assets as we go into the lending process. Now, I've been doing this about 23 years. And still, I encounter a lot of the same types of questions from my borrowers. Some of those things are about this particular subject is what is eligible and verifiable. And when you're talking about an eligible and verifiable asset, it's something where it can be tracked where it came from, where that money came from. So for example, money that you have in your bank accounts, money that you get from your paycheck, money that you may have in investment accounts, money that you have in that you get from Social Security or child support, or even public assistance. All of those things count as verifiable assets. That's stuff that's income that we can use and assets that we can use to be able to say, hey, this, beyond the shadow of a doubt, is money that this person has that they can either put towards this transaction, or that can be calculated into what we call the debt to income ratio. What you can't use is what we sometimes call mattress money. And that means money that was stuck, the old thing where you had money stuffed under your mattress. So for example, if you are pulling money aside and you have cash and you just have been stuffing that in a jar, or you have one of those big water bottles that you put your change in, and you're sticking all of that money in there. And at the end you say, well, I've got a lot of money in there now. And then you were to try to use that money towards purchasing a home, or any of these purchase type transactions or these financial transactions. That is not going to be money that we can use towards that transaction, unfortunately, because we can't track where that money came from. What we're really looking for, and you can see here on the PowerPoint, we're looking for money that you have in your checking account, money that you have in your savings account, money that you have in investment accounts, like it says here. We also are looking for, it's very easy to track money that has come from your paychecks, like I said, your employer. If you have a second employer and you have been there for several years, we can use that money as well. Sales, we can, anytime there's been a sale of something and we have a bill of sale, or if you've sold like a previous property, or maybe you inherited some property, and you knew where that property was sold, and there was what we call a closing disclosure from that. We can use that all as verifiable and eligible assets. Like I said, the exception is when we can't figure out where that money came from. Now, with that, sometimes we can have deposits that go into, because we actually look at your bank statements. And we look at the deposits that went into your, say, investment accounts. And we're looking for any unusually large deposits. So this is what that would qualify for. Actually, this is how that would look. Let's say you make $4,000 in a month. With a $4,000 in a month, if there is a deposit in there that is 50% of that or greater, then we're going to have to verify where that deposit came from. So for example, in this case, $2,000 or above, we would have to verify where that money came from. Most of the time we can verify it if it came, for example, like you sold a car, or you sold a recreational item, or you sold, and we have a bill of sale and we can show where the money came from here and went there. One extremely common practice when you're purchasing a home is for maybe a relative, or mom and dad, for example, maybe a spouse would be actually giving you money towards the purchase to help you get started. And when we do, that's called gift funds, by the way. And gift funds, like I said, are very, very common. Even like, say, for example, if one spouse has an excellent credit score and the other spouse doesn't have as good of a credit score, but of course, the person that doesn't have the strong credit score has more money in their accounts, and they're married, or let's even say they intend to be married, we can use the gift funds from the spouse who doesn't have as strong of a credit score and is not even on the loan. They can gift funds to their spouse towards the transaction. Same thing, we can do that from parents to a child. And there's a number of different categories that are going to qualify for that. Feel free to call me at that 225-315-1815 number if you feel like you need clarification on would this particular gift qualify. Now, one thing that's important with that is we're going to do a thing called a gift letter, so that the parent, in one example, who's given the money to the child, will sign a gift letter saying the money that I'm gifting to my child is coming from this account and it's going to their account. And we will have the account numbers, and we will actually pull statements from the parent, or the parent will provide those statements in our example. And we'll show, you see where it came out of account number 1, which is the parent's account. And here's where it was deposited into account number 2 to show where that money came from. And it's a very, very common practice to do that. If you could just go to the next slide. So when you're doing a loan, there's always going to be some associated cost with it. Now, in some cases, as recently as last month, I've had people move into homes and they pay almost nothing out of pocket. And in those cases, that's when the seller is paying closing cost on the buyer's behalf. However, if that's not the case, I want to go over some of the costs that would be associated with doing a mortgage when you're buying a new home. The first thing is your down payment. And we're going to go over different types of loans and different down payments. But let's say, for example, you have $100,000 house, to make it simple, and there is a 5% down payment, then $5,000 would be the down payment. That would be part of the cost associated with getting this loan. So the loan amount in our example would be $95,000. That would be an example of one down payment. If you have a 3.5% down payment in our example, then it's same, and if we still had a $100,000 house, you would have a $3,500 down payment. That would be the first cost associated with it. Now, in addition to that, you have some things called closing costs, and I want to break that down for you. This is one that a lot of people don't anticipate, and that is the prepaids. And what the prepaids are going to be your homeowner's insurance / flood insurance. So some areas in Louisiana, for example, they're in flood zones, and those we require you to have flood insurance. And then some are not in flood zones, and obviously we would not require flood insurance in those zones. So you would have your homeowners / flood insurance. And what we're typically going to do is we're going to hold a year up front. So if it's $1,000 for your homeowner's insurance premium, we're going to hold at least 1 year up front. But then in addition to that, we want to make sure that you have enough in your account, your escrow account is what we call it, so that when your homeowner's insurance comes due, say in December at the end of the year, that we hold out enough months, and even we usually put an extra month minimum as a cushion in there, so that when your insurance comes due at the end of the year, there'll be enough in that account to pay it in full, and you won't have to worry about it. When you're prepaying insurance like that, though, that would be $1,000 added to your expense. And let's say we hold out 5 months plus 1. Well, now that would be the additional, we would hold out those 6 months of the premium, so that there would be enough there to make sure that there would, at the end of the year when it came due, there would be enough to pay. Now, once you start paying your notes on the home each month, and after you get past your first year, your escrow accounts will always pay your homeowners, or if flood is required, your flood insurance. The same exact thing happens on your property taxes. So if your property taxes, let's say, are $1,200 for the year, we're going to generally hold $1,200 plus we're going to hold, let's say if we needed to hold 5 months plus 1, that would be another $600. So that would be a total of $1,800 that would be held out in property taxes to make sure that there would be enough at the end of the year when the property taxes came due for those expenses to be paid. So let's just look on my example with those two. You're looking well over 2,600, where you would be it would be well over what, $2,600. So that can be kind of pricey, and people don't figure that in when they're talking about their closing costs sometimes, because they go, wow, I didn't realize it was going to be that much. Now, your loan officer will discuss this at the beginning, and if it fits within guideline, your seller is taking care of closing costs and prepaids, that can be a credit to you. And I know this sounds a little bit complex in our short period of time that we have here, but that is something to definitely discuss with your loan officer at the beginning. The next thing is an origination. That is basically going to be the cost that you're paying to your lender to pay the people that have to work on this loan. So there's going to generally be in the first part of what's called your closing disclosure, you're going to see where the fees, what are the costs to originate that loan. And those things will sometimes be split into additional fees. So for example, not additional, but split into individual fees, I should say. So for example, processing fees, which is next on there, processing fees will be in that origination section of the closing disclosure when you start looking at the cost of the loan. Processing fees, sometimes it'll be administration fees, sometimes it'll say doc prep fees, but that's all going to be expenses that are associated with the closing of that mortgage on the home. And the next thing that you can be looking for is a credit report fee. Now that'll be collected right there at the application, usually between $35 and $50, somewhere in that vicinity. But that credit report is what the loan officer and what the underwriter and everyone is using to see exactly what debts are reporting on your credit. And also it is what level of loan are you going to qualify for? Obviously, the higher the credit score, the better terms that you are going to qualify for. And that is a different discussion, but we'll be happy to go over that with you if you would like to contact me individually on that. The next thing is there's going to be an appraisal on the property. And what the appraisal is doing is it's going to tell you what the value is, and it's really for your protection. So for example, if a house if you're paying $200,000 for a home, you want to make sure that it at least appraises for $200,000. So in that way, you know, you're paying a fair price for the home. So the appraisal will be figured into there. That is collected up front in most cases, and because the appraiser, who is independent of the bank, needs to be paid for the work that he or she does. And then that would be used usually at the end of the loan. You will see a credit on what's called your closing disclosure, because you have prepaid that generally on the front end. The next is title insurance. So there's going to be a title company that closes the loan for you. And there is going to be insurances that are associated. And that title insurance is split into owner's title and lender's title. Lender's title is required and owner's is optional. However, many title companies or title attorneys will tell you that it is good to have that insurance in place, so that if there was ever any type of cloud, we would call it, say, a cloud, or if there was ever any type of problem with the title, the insurance would cover the cost of taking care of the curative legal work that would be required to make sure that the house is, in fact, 100% in your name. The next thing is called mortgage insurance. Anytime you're doing a loan that is more than 80% loan to value, when I shouldn't say anytime, but on a conventional loan, on a mortgage that is greater than 80% loan to value, there will be mortgage insurance associated with that. And what that does, it is part of your payment, but the mortgage insurance is there, and it's designed to essentially minimize the risk to lenders who are lending above 80%, because statistically speaking, the higher the loan to value, the more money that is lent against a home, statistically, there's a little bit more risk associated with those loans. And that is one thing that mortgage lenders put in place to mitigate those risks a little bit. A guarantee fee, now that operates differently for different types of loans. So instead of going specifically into all the intricacies with, say, like a VA guarantee fee versus a FHA versus a conventional, just know that is to guarantee certain terms of the loan. A funding fee is actually because we are paying, in many cases, entities to help to take that process to where a loan is being, funds are being transferred to fund the loan so that the transaction can go through. Attorney's fees are going to be associated with the title company, and that is for the title company to research, they're researching the title, and they are making sure that the transfer of title from the inception of that property all the way to you buying it, making sure that there are no liens, that what we would call prime your loan, meaning that nobody could come later and say, well, I had done some work on that house and I was actually owed, say, $3,000 for that work, and that was never paid. In other words, the attorney is going through all of those things to make sure that that is not ahead of your mortgage, because what could happen is that person could come back later and say, hey, I have rights to that house to be able to get made whole on what was owed to me. And that could cause a number of problems. That's what the attorneys, what you're paying for, is you're making sure that he has gone through all of the different public records and tax records and things like that, to make sure that none of that is going to come back to haunt you 2, 3, 4 years down the road after owning that home. And then last, the parish or the county, if you're not in Louisiana, is going to charge recording and transfer fees. And what that means is that there is going to be, your mortgage is going to be actually a part of the public record. It's going to be recorded as part of the public record. And so the title company has to pay the recording and the transfer fees that the state charges in order to make that happen, so that the mortgage will be recorded in your name. What you'll typically see is a cancellation of the old mortgage and then a recording of the new mortgage. So can you go to the next slide, please? One more after that.
Oh, is there another? Okay, mortgage loan. But before we move on, I wanted to ask you, will you just define your role in this process?
Absolutely. So I'm going to be this person that you're speaking to. I'm going to be your loan officer, and I'm going to be guiding all of this process for you. Kind of, and I'm think of this analogy. I'm not a lawyer, but I like to say we're like a lawyer, and the underwriter, the people that that's going to be the judge, right? And so what we're going to be doing is we're going to be collecting all of your information. I'm going to collect your W-2s and your paycheck stubs and all of these different documents from you, and think of that as evidence. And I am going to be gathering as much evidence as I possibly can, so that when I present your case to the judge is most likely to review the evidence and say, this is a case that I'm going to sign off for in your favor. In other words, you are going to be victorious. So I'm going to be that person who is your advocate through this process.
Advocate. I love that word.
Yes, I'm going to be, yes, we're going to be talking about, okay, this is going to be an issue here, but this is how we fix this issue, and this is how we move you to the next step. In my personal experience with my first home, had I not had the right team or right people advocating for me, I would have never in a million years even thought I would have qualified for a house. But
Wow.
luckily, because I had those people around me, they were able to bring me through the process. And I had an
Well,
amazing.
and then starting with partners like Raina.
100%.
yeah.
That's why I liked what Raina said, the way she laid that out, because, you know, you have to have a plan. You have to understand parts of this process so you don't go into it blind,
Mhm,
because it can be a little intimidating if you've never
mhm,
experienced all of this
mhm,
before.
mhm. Okay, thank you for stopping and do that. Okay, next slide.
No problem. So we're going to talk a couple of minutes about all of these options, because one thing that we have here, especially at Hancock Whitney Bank, is we have a number of great options for you. And one of the things that
Let me make sure that Mindy's not going to be the expert that talks about this. What do you think about that?
Oh, so we can turn this over to Mindy then?
Yeah, Mindy, thank you, Brian. I think that was fantastic information.
Okay,
And
thank
I
you.
know that you'll be, at arm's length as Mindy goes through this, so you're welcome to pipe in, but thank you so much.
You're
Mindy,
very welcome.
come on in, Mindy.
All right, I'm here. I'm ready.
All
All
right,
right.
here we
Thought y'all
go.
were gonna pass me by.
No,
I
never.
apologize.
That's okay. You did a great job, Brian.
He's just having so much fun. He's moving it on.
Yes, he is, and that's okay. Good afternoon, everyone. My name is Mindy Denicola. I actually recently had a work anniversary Friday, the 27th of May. I have been with the bank for 36 years in mortgage lending. So I am very passionate about what I do, and I thoroughly enjoy what I do to help you achieve your goal, your dream of homeownership. So what we're going to do today is we're going to go over our different mortgage options, the different loan types that you can expect to hear from your lender and discuss with your lender throughout this process. So as you see on the screen, we have 4 different options, but really it's 5. And the reason it's 5 is because for conventional, we have a Fannie Mae option, and we also have a Freddie Mac option. Okay, so under the conventional umbrella, we have 2 different options, Fannie Mae and Freddie Mac, and you all may have heard that term before. Okay, then we're going to also go over our 3 government options, and our 3 government options are FHA, VA, and rural development. Next slide, please. So let's go over the conventional loan option first. For a conventional loan, your minimum down payment requirement could be 3 to 5%. This conventional loan, if you do not put 20% or more down, as Brian mentioned previously, you will be required to pay monthly as part of your payment, private mortgage insurance. Now, you may have also heard the term PMI. PMI is for the private mortgage insurance. With a conventional loan, here at Whitney Bank, we traditionally do 30-year fixed interest rates, especially for first-time home buyers. Now, as far as the down payment requirement, and you can see there are some bullet points here. So our lowest down payment requirement is 3%, as we stated earlier. That would represent a 97% loan. That would be the loan to value. Okay. Another option for down payment for a conventional loan is 5%. That would represent a 95% loan to value. Now, as I mentioned earlier, remember we talked about conventional, and under the conventional umbrella, we have Fannie Mae options and we have Freddie Mac options. Well, for our Fannie Mae option that allows you to put 3% down, that is our Home Ready product. Okay, so in order to put the minimum down payment of 3%, that would be for our Fannie Mae Home Ready loan. Freddie Mac has a similar loan product. They call it Home Possible. So through Home Possible, you can put the minimum of 3% down as well. Now, with these two options, Home Ready and Home Possible, you do have to be a first-time home buyer, and you will have to complete home buyer education. Miss Raina can help you with that. Now, with Home Ready and Home Possible, we do have to look at your income. Okay, so there's going to be some income restrictions for Home Ready and Home Possible. And what that is 80% of area median income. Now, I'm not going to go into detail about that, but if we had a one-on-one conversation, I would be more than happy to let you know for your area of where you would be purchasing a home, what the 80% AMI or area median income would be, because different areas have different limits for the income. Under the Freddie Mac umbrella, there is also a Home One product. And this Home One product is not specific to income at all. And you know what else? This Home One product by Freddie Mac, it allows you, if you're a first-time home buyer, to put 3% down. So here we go. We have another option that doesn't have any income limits that allows for someone who's a first-time home buyer to put 3% down. We also have refinance options, whereas you could, if you may know somebody that might want to refinance, and if they do, then they could either refinance the rate and term, or if they wanted to pull some cash out, they could do that as well. Next slide, please. So now let's talk about the FHA loan. The FHA loan requirement for down payment is 3.5%. With FHA is going to collect an upfront and a monthly mortgage insurance premium. So regardless of the down payment, whether it's 3.5% down or more, you are going to be paying an upfront and monthly mortgage insurance premium. You may have also heard the term MIP, and that in particular stands for Mortgage Insurance Premium. This FHA loan is going to be a fixed rate. It allows for a purchase or a rehab, and also refinances as well, where you could refinance for rate and term or pull some cash out. Next slide, please. Our next loan type, and this is government. So remember, we have 3 government loan options. Our 3 government loan options were the FHA that we just went over. Now we're going to go over VA. VA allows 100% financing, so there's no down payment. However, you have to have served in the military, and on top of that, you have to have your certificate of eligibility. That is also called a COE, okay? Now, with a VA loan, the VA is going to collect an upfront funding fee. And this funding fee can be paid cash at closing, or it could be financed into the loan. Most everybody finances it back into the loan. It is for veterans only, and it will be a fixed rate. And the VA loan type, they also offer that refinance option, you know, whether it's rate and term or cash out. Next slide, please. The third government loan type that we have to discuss and go over today is rural development. Now, you may have heard the term USDA. That is one and the same. So rural development, or RD, or USDA, that is all the same loan type. This loan type does allow for 100% financing, which means no down payment. It is eligible in rural areas, but don't think of it as being restrictive to rural areas, because we have recently had rural development allow for suburban areas. And I'll let you know, in our area, for the New Orleans metro area, in particular, Orleans Parish is not an eligible area. And Jefferson Parish on the East Bank is not. However, the West Bank of Jefferson Parish is, and surrounding parishes. And where you all may be interested in purchasing in the Baton Rouge market would be eligible areas. We would need to know an address. So you would need to provide an address to myself. And I could look up on the Rural Development's website to see if the property, the subject property that you would be interested in purchasing would be an eligible property, okay? What we also need to look at for rural development is your income, the income coming into the household. So what rural development is going to do is they're going to ask us, me to ask you, how many household members do you have in your home? And then we're going to break it down a little more. So of these household members, who brings income into this household? Okay, and we have to look at that. So it could be your employment income if it's for you. If you have dependents, maybe they receive child support or Social Security. Maybe you have an elderly parent or relative living with you and they receive their retirement or their pension. So we're going to have to focus on, asking, how many household members, what is the household income coming into that household? And then we have to see if you are eligible based upon income as well. So rural development or RD or USDA is going to look at where the property is and if it's eligible. And then how many are in the household, and if the household income does not exceed the limits of their program, okay? With rural development, like FHA, is going to collect an upfront and a monthly guarantee fee, okay? And the upfront guarantee fee can be either paid cash at the closing or financed into the loan. And most everybody finances that upfront guarantee fee in the loan. This will be a fixed rate as well. And rural development, just like the others, offer that refinance option, but only for rate and term. Next slide, please. So that is my information, my contact information. Again, my name is Mindy Denicola. I do have hyphenated name, Tysan, that's my legal name. But being in the industry as long as I have, my career is mainly Mindy Denicola. So that's why you see me use that name mainly. I am a community loan originator, and I would be more than happy to assist you with any questions that you may have. Whether you have questions today or in the future, please feel free to reach out to me. Email is probably best. That way I can schedule a specific date and time to speak with you. That way we don't play telephone tag, because I say pretty busy. And I just like to manage my time the best that I can. So if you email me, that would be preferred. And then that way we can set that special time aside.
Fantastic. That's wonderful. Thank you so much. I think that was wonderful information. As I ask Mindy some questions, I would love it if those who are on and are getting some wonderful little nuggets that they're dropping here, if you would just tell us the one thing that that you took away from it in the chat. Just you hadn't heard this before, you are walking away with a better understanding about that, whatever it is. We'd love to to get any feedback from you as it pertains to the effectiveness of what we're presenting today. But Mindy, how like when you sometimes go and want to purchase a plan and they have the plans side by side, and they have the columns and they have check boxes next to, the different features and assets of the different plans. That's kind of how I feel like what you presented today is, all the mortgage options side by side. If you looked at the difference, what differentiates them, what would you say is the biggest differentiator between the different loans? I mean, there were so many different variables. Like if you're a veteran, obviously you don't, if you're not a veteran, you don't qualify for the VA. If you don't live in the rural areas, you don't qualify for that. But even with the conventional loans or whatever, what are the biggest things? Your credit? I mean, are they looking at your credit? Are they looking at your income? And then is it that dictates your interest rate? Like, is my question making sense at all? I mean, it seems like it's a hodgepodge menu of mortgages galore, but not really. I mean, you either qualify for it or you don't. You either have this feature or you don't. What's the biggest differentiator when choosing a mortgage?
Well, and I guess it depends on the market and the time, because sometimes our government rates, interest rates, are lower than conventional. So maybe if someone's considering doing a conventional loan to have that lower down payment requirement, right? But then on the flip side, for FHA, the down payment requirement is a little bit more, but the interest rate would be lower. So it really just depends on the market at the time. And we do here at Hancock Whitney, I know I do, provide loan comparisons. Okay, so what we would do is when we would get a client's loan inquiry, we would go over those different options with them so that they can see the comparison side by side.
That's exactly right. I mean, I know I didn't use a very good analogy like Brian did, but Girl Scout cookie menu, this is like a much more serious thing. But when you put it side by side, there have to be some differentiators. And I know, again, the VA and the rural are the blatant ones. Either you are, you aren't a veteran, you are, you aren't. But it seems to me like there's some other variables. And then another question that I would love for you to answer is,
Angie, before we go any further, if you don't mind, great question, great comment, Mindy. We do have Tish Allen, who's the Vice President of the Community Lending Department, and she may want to chime in on that first question as well. Okay. And then we can move on to the next one if that's okay with you. Tish, if you will, unmute yourself.
Let me see if she can unmute herself. She may not be able to. I will allow it to talk. Okay, there you go.
Okay, there she go. Hi, Tish.
Hi, everyone. So I think Mindy did a great job. Brian also did an excellent job as well. And so I think the two differentiators, if you're going to look at a conventional, so if you have to put conventional and FHA side by side, the first thing is you can get a conventional loan. There's conventional loans that are available that will allow a 3% down payment. 3%. So if the loan amount is $100,000, then we're talking about $3,000 for a down payment. If you're looking at an FHA loan for the same loan amount, $100,000, you're going to have a 3.5% down payment. So let's say $3,500 down payment. That can be the two immediate differentiators between the conventional loan and FHA loan. That's one of them. Okay. The other could be each loan program has their own baseline credit score or credit requirement. All credit scores are not created equal. I say that because you can have a program or your credit score, let's say, could be 620. The baseline minimum for an FHA program could be, I'm not saying that it is, let's say could be 620, or conventional could be 620. And for whatever reason, you may have two people with the same credit scores. One can get an approval and another may not. Why? It could be because credit patterns. So it could be that one person has their credit score is made up of credit maybe that they've had for maybe a year or 2 years, but they paid it on time. They don't have a lot of credit, but they've had it long enough for a lender to determine, or an investor to determine, the likelihood of that person paying their bills on time and that they're going to pay their mortgage on time. Another may receive a denial for the same credit score, that same number, but maybe they have a 620 because they had a delinquency within the past few months. Maybe they have some outstanding collections or defaulted student loans, a car repo or whatever, but there's 1 or 2 other cards or debts that they're paying on time. So you could have 2 programs that may have the 2 basic minimum credit score guidelines, and for whatever reason, depending upon the makeup and the profile and the history of how you pay your creditors, you may get an approval for one and not approval for the other. Again, depending upon your personal individual makeup of your credit, how you pay your creditors, what's the current standing of your credit at the time. So those are just 2 differentiators.
No, but those are huge. That's
Yeah.
exactly why, that's what I was, talking about. And that's why we did a whole session on credit management, budgeting, and financial health, because those sound like very big differentiators,
Yeah,
that's-
and it could be, and to also I'm going to add a little bit to this. You heard Mindy and others, you may have heard them mention Fannie Mae and Freddie Mac. FHA, those are, especially Fannie and Freddie Mae, they are the largest mortgage investors in the country. Most conventional loans that are issued in the country are underwritten and held by Fannie Mae or Freddie Mac. Now, there are some, they write the rules, but there are some investors that mortgage companies and banks might use that may add an additional credit score requirement to a Fannie Mae program. The Fannie Mae program may say, hey, a home ready program, minimum is 620. But another investor who offers the same product and says, historically, we've not had the best experience with loans performing at, good performance on loans with clients that are 620. So we are only going to accept a credit score of 660. So you may have one lender that says, hey, we will accept this minimum score of 620, but then you'll have another lender that may have a higher credit score for the same product. It's usually, that's how the industry works sometimes. So it's not, again, all credit scores aren't created equal, and lenders or investors are not just looking for that number, but they're looking for how the loan actually performs, how your credit, I should say, has actually performed, and the likelihood of you repaying them and not defaulting on debt. That's the reason why the money management part of this program and a credit portion management of this program is really important, because an investor is going to look at how you pay your bills. And if you pay them on time, if you pay other creditors on time, even if you've had a hiccup here or there, life happens. Life is not perfect. And if something happens, but you were able to rebound from that, and they can sort of see that in your pattern, like, oh, okay, they had this back then, but look, they've gotten back on track, they're paying on time. All of that helps you. But every loan program will have different mitigators for credit, or different things that they may feel comfortable with when in regards to your credit. Some creditors may want to see this, another creditor may want to see something different, and it could be under the same mortgage program. And so I want you to understand that, and that's the reason why working with groups like Mid-City, working with lenders such as Brian, and working like Mindy and others can really help to coach you so that you can prepare yourself to be bankable. And that when you walk into an institution that you are prepared, and the likelihood, if nothing changes, if the likelihood of you getting the credit that you're seeking in order to buy the home that you want can be, the probability could be a little bit greater than if you try to do this on your own.
I think that this is a fantastic information, and I love that the last couple of times you've been in impromptu and answering these, because it's very thorough and provides some color around it. I'm unmuted everybody So you have the ability to talk if you would like to. You're not on camera. We can't see you. Just will hear your voice. You don't even have to identify yourself if you don't want to. But to LaCarsha's point, you have at your fingertips experts that can answer your questions. And that is invaluable. I mean, truly is. And so we have just a couple more minutes. And so if you wanted to unmute yourself and ask a question that, you know, is within this realm of discussion. If it's not, we'll, you know, get your name and information and take it offline. But please, you know, go ahead and unmute yourself, ask a question, and then keep those nuggets coming. I love that Miss Annetta said that the takeaway was that Fannie Mae and Freddie Mac options under the umbrella of the conventional loan had no clue they were part of the conventional loan. And then we had Mr. Bishop say expansion of the RD loans. You know, that's something that I wasn't familiar with that either. So what else? You know, one other thing that anybody else took away from our resources today?
I just wanted to ask a question. I know they talked about first home home-owned buyers, but I didn't hear anything about people that already purchased a home and how can they go about doing things differently than they did the first time.
I think that's a fantastic question. Who wants to take that? Mindy or Brian or?
I can take it. If Mindy, do you want? Okay.
Come back
Well,
on camera, Brian, for us.
Wait, hold on one second. Let me get you. There we go.
There we go.
So absolutely, there's just as much opportunity for people who have already purchased their home and looking to improve upon maybe maybe they want just a larger home now for their family, or they want to look at a different type of program, do a refinance, build a home. Any of those things are available. And then one thing that we really have right now that differentiates us from a lot of other people is we have that first-time home buyer opportunity program, but that also applies to people who are either doing a refinance or they just want to buy another home. And so you can basically buy in particular areas of certain cities and do very, very well with the financing. And those are really great programs because it's 100% with no primary mortgage insurance. So you have 100% financing, and then you don't have to be thinking even about the fees that are affiliated with, like, say, for example, an RD loan or an FHA loan. That stick with there, you know, for forever. You know, so we have all kinds of opportunity with that. So I would encourage you, just get in touch and I can answer about your specific situation, because yes, second, third, fourth homes, we do quite a bit with that.
Okay. All righty. Thank you. I didn't need to hear that. Thank you.
Oh.
We did have a question come in for Raina. What is the geographic area that Mid-City serves? So I think that's a good question. And the reason why I say that is because we've been promoting, and someone, if you would, please go ahead and put your phone back on mute. We hear a little bit, yeah, thank you. Background. So we've been promoting, you know, different markets. So Gulfport, Tampa, Baton Rouge, you know, perhaps someone crossed over and registered for, you know, like if I registered for Tampa, but I live in Gulfport, and there was a community partner there. Can people utilize your services if they're not in their immediate area?
Correct. So we used to service just the mid-city area, but now we do mid-city surrounding areas. So it doesn't matter where you're from if you want to just get the education piece. Because like I said, in the foreclosure prevention, it's anywhere in Louisiana. So it can be anywhere if you want the education piece. Now for the assistance programs, it may be certain areas that you can't cross over to, but I can definitely get you to somebody that's HUD approved in that area that you may want to, you know, sit with or whatever. But our services is anywhere in Louisiana. I have programs actually in Monroe that I'm dealing with right now. So it's really Homa. It's really broadening now. It's not really in just the mid-city area.
Okay, perfect. Now you do the certification, right?
Yes, I do the home buyer education certification as well.
Okay,
So you can
if-
come to my class, but so if you go to, so say if you go to Texas and you take my home buyers class, it's still HUD approved. So
Okay.
regardless of what state you go to, you may
Okay.
have to take it over due to, you know, but the
That's
education
good.
is still the same.
Perfect. Okay, we probably won't address this today fully, but I mean, just a quick answer is any info on construction loans? I mean, is there any bridge that we can create to construction loans, and or can we, Mr. Otis, you mind if we get some information from you, or if you take down the information that's in the chat so they can address that offline? Or is there something specific you want to know about? And then as he's you know, maybe putting something in the chat for us. Someone also, one of the nuggets they took away was they never heard of a home ready, and the other one that it was new to them. So that I think that's fantastic that we were able to introduce that information. So
And if I could just interject, I'll be really quick. The home ready program was designed, was an affordable, I guess you can say, sort of program designed by Fannie Mae, probably over about 5+ years ago, to encourage more individuals throughout the US to become homeowners. So that's Home Ready. So it's a Fannie Mae specialized program to help communities grow and thrive by creating more opportunities for home ownership. And then Freddie Mac has a program that's almost a mirror of Fannie Mae's Home Ready, and theirs is called Home Possible. And both of them offer the 3% down payments, and they both have the same mission, and that's to create more homeowners throughout the US. And both programs do require that the borrower obtain some sort of home buyer training and education. They really believe that education is the key, like with anything else, and it's no different with home ownership. But just wanted to make sure that that the person who asked that question understood that that those are two specialized programs under the conventional umbrella that is offered either by Fannie Mae or Freddie Mac.
fantastic. So we do have a question. Do you include rent in debt to income ratio? Who wants to take that?
Yes, so we do include the rent index. Well, when you go to, not when you go to a lender, but when we talk about a budget, not in debt to income ratio. Let me back up, because debt to income ratio is basically when you go to the lenders and they look at all your debt on your credit report versus your income. You see what I'm saying? So debt to income ratio, we'll discuss it in the intake process. But when you go to the lender, they'll just, like I said, they'll just go on your credit report versus your income. We'll do credit report, income, but we'll also do a budget, which will tell you, you know, exactly how much you can afford after you pay those other expenses that's not on your credit report.
Okay.
Okay.
Ms. Susan asked if the PowerPoint slides are going to be available. Ms. Susan, we're going to send out the link to this, and the PowerPoint will be part of the video. So I hope that'll help. And Mr. Otis is going to contact someone from Hancock Whitney about the construction loan information. But what we'll also do is email, since we have your email addresses, we'll email back out the contact information for the Hancock Whitney presenters in the event anybody wants to follow up with them individually. I think that's smart and right to do. And so, LaCarsha, you want to come back on camera and help us close it out and say thank you to so many people. Let's see. Thank you. So thank you for saying thank you. That's a great presentation. And Brian and Mindy, y'all are welcome to come back on too, just so we can say goodbye. and y'all, everybody, this is just, I don't know, it's like a family, almost. I mean, it's the family of people that surround you with the resources and information that you need to buy a home. And it should not feel like you're doing something wrong. You know what I mean? This is what it should feel like. It should feel like you're doing the right thing for you and for your family and for your future. And then you feel safe and secure in the information that you're getting and the people that are surrounding you to make it this successful. So I certainly, feel that way if I ever have to buy a home again. I know the team that I'm going to call in. So is there anything else that you want to say to the people that are on before we close it out today?
Sure, I'll say a few things. First of all, thank you to everyone for joining, all of our attendees, our participants. We are so grateful that you've joined us for this credit management, budgeting, and financial health session. I hope that it's been beneficial to you. Thank you for your comments. And we're looking forward to session 3, which will do a deeper dive on the mortgage loan resources. So feel free to join us during that session as well. Thank you, Mindy and Tish, for joining in. Thank you, Brian, as well as our community partner, Raina. Thank you all so much for your expertise. You gave our viewers, our participants, a great opportunity to ask those questions that you can't get the answers to on Google. So thank you all so much. Great presentations. I do want to say a special thank you. We have a few people on the line that I saw. I'm thinking that Craig Coleman was able to join us a little earlier. We do want to give a shout out to him. Thank you for joining us. He's over the mortgage production department in this area, in the Baton Rouge area. Thank you again, Tish. She's over the community lending team. And thank you to I think I saw LaTanya Woods, as well as Stephanie Johnson, and a few other of our mortgage loan originators, and as well as our community loan officers. Special thanks to Anthony Montgomery for joining us. He actually made the introduction between us and myself, as well as Angie. Great partnership. Love the opportunity to work with you as always. You're always so willing to help us provide access to home ownership to the communities that we serve. But I do want to give just a few little snip takeaways. I heard Raina say during her presentation, she said the importance of reducing your spending. And she says one of the ways you can do that is by joining in on free events. I like that. And she says, just because it's free doesn't mean it's not valuable. That was powerful, Raina. I love that. And here at Hancock Whitney, we mentioned earlier, our mission is to help people achieve their financial goals and dreams. And we've partnered with the Legacy Business League, with Mid-City Redevelopment, our mortgage loan officers, our community lenders, and we have provided the community with free virtual homeownership access. So that was powerful. I love that. So that lets you know how compassionate we are here at Hancock Whitney to ensure that the communities are aware or educated so that they can, navigate through the home buying process to make it as simple as we possibly can. So that's our passion.
We had another question come in that I think is valuable.
Okay.
Ms. Paula asked, are there student loans calculated now? I know there was a change. And I guess the change would be that they weren't, because I know when I was buying a home, they did calculate the student loans.
Right. It's different. So I'm just gonna say this. It's different processes at different lenders. Some lenders still calculate 1 to 5%.
Oh.
So what, and I would also say, what I would also say is to Raina's point that as a lender, and I want you all to make sure you process this, lenders follow the credit guidelines of the investors that provide the mortgage products to us. Lenders follow the guidelines of the credit guidelines of the investor products that we use in order to extend you a loan. So for instance, under an FHA loan, a VA loan, under USDA loan, those loan programs and conventional, no matter who the investor is, whether it's Fannie Mae or Freddie Mac, they stipulate how we can calculate student loan payments. There may be an instance where they may accept a payment letter. There may be an instance where they may not accept a payment letter. There may be an instance where we have to calculate 50 basis point or a 0.5% of your total student loan balance to come up to derive with an actual monthly payment if you don't have a payment or if the payment is in deferment. And the reason why payments are important is because investors who purchase these loans, who purchase and own our debt, they look at how loans perform when student loans are in deferment and they haven't calculated a payment. So there was a point in time where, whether it was Fannie Mae, whether it was Freddie Mac, a conventional loan, a government loan, where sometimes in the past student loans were in deferment and they didn't calculate the payment. Well,
Right.
they saw that those loans perform, some of them, not all of them, may have performed poorly in that when those loans came out of deferment, then the borrower had trouble making the student loan payments and paying the mortgage. Okay, so what they said is, you know what? We need to ensure that we calculate some form of payment toward the student loans. We have to ensure that the borrower can carry their student loan debt along with their new mortgage payment obligation. So
Right.
each program is going to dictate how we're able to calculate the student loan payments, and everyone's student loan situation is going to be different. No one is going to be the same. So your friend could say, oh, they did this for me. Usually people don't give you all of the details, and maybe because they don't understand all the details that we have to use and consider as we're looking at the credit guidelines for the investor that is ultimately going to purchase your loan. We have no power when it comes to that because we have to follow their rules. So their rules at that time when we're trying to assist you becomes our rules. But typically we're looking at third-party guidelines to ensure that we meet those standards in order to extend you the mortgage credit that you need in order to buy your house.
Right.
I would just go off of what I would say, listen to what Tish just said and then listen to it again.
Mhm.
And then after that, listen to it a third time.
Yeah.
Because
Yeah,
she
'cause
said a
it'll change.
lot there.
Wow.
And when you're thinking about people who are coming to us a lot of times, yes, we want to help you. Remember,
Mhm.
we're on your side. We want to make this
Right.
happen for you,
Mhm.
but we have to follow guidelines that are set before us. I can't do something for one
Right.
person and not do the same thing for somebody else.
Yeah.
It's
Right.
got to be universally applied. So when you think of some of the people today, I mean, you can literally get student loans as a, first semester freshman all the way through your PhD. Well, you can
Right.
imagine that adds up. And so Tish is right. When that student loan payment finally comes due, it can be significant. It can be in the way that, when you have that significant payment plus your mortgage payment, it can be a little challenging. And people say, well, what if it's a doctor? They make so much. No, that's not true. If you start out with $300,000 in student loans, that can be a significant payment.
Right.
A veterinarian, an attorney, people who go, get their PhD in physical therapy. I mean, I could go on and on and on. I used to joke around as a loan officer and say, when I saw the word doctor, I would shudder and pray for rich parents somewhere. Because I know that student loan payment is going to be a
Right.
monster.
Oh, no, I hate that. Okay, well, Raina, you did have Mr. David. I asked that you give him a call. I emailed you his. It was left in the chat. So, just
Okay.
in the interest of time, we just want to thank all of you. And again, I think this was an hour and a half well spent. And Mr. Bishop, Mr. Soule asked if the session 1 is not yet available for review, but it will be, and y'all will be the first ones to know, because again, we have your email addresses and we're going to be able to email out the links or the place where to go and get the link, so that we might make that available sooner than later. We're trying to wait till all 3 series were done, but it makes sense for you to go back and check it out, 1 and 2. And so you can prepare for 3. So we'll get that prepared for you all and get it out. So thank you again for your partnership and for making yourselves available to the community and dedicating your time and energy, and for those who need it the most. And hopefully we'll see y'all in session 3.
All right.
Okay, have a wonderful day.
You
All
too.
right, good. Well,
Bye-bye.
thank you, everyone.